Have you ever wanted to own private rental real estate in your portfolio and benefit from the rental income? Well, check out today's episode as we talk to Avenue Living, Canada's second largest private REIT. Hey, welcome back to Money Match. It's Ian Ardill here. We are joined together with Gabe Millard. Gabe is the managing partner at Avenue Living. Welcome to the show.
Oh, thanks for having me, Ian.
Well, Gabe, thanks so much for making the time for us. For those that are listening in or just wanting to learn a little bit more about what is Avenue Living, I'm just wondering if you can address who's Avenue Living, and more specifically, I'm wondering if you can give us our kind of a 1 or 2 minute pitch on the Core Income Trust.
Perfect. Yeah, happy to. Yeah. Avenue Living is, what we call an alternative asset manager. We focus on alternative private products, focused primarily on real estate. We like to think of our investment thesis as a pretty simple one, and that is investing in the everyday. And what we mean by that is we invest in products that really affect the everyday individual. So we're not in your exotic hedge fund strategies. We focus primarily on your basic core products. So in multifamily, that is workforce housing. That is your individuals making $15 to $50 an hour, and it tends to make up about 40% of the Canadian economy in terms of a demographic profile. In self-storage, we focus on your legacy run assets. And on our farmland space, we focus on core grain products in the province of Saskatchewan. What we then do is we take our internalized management. So we do all of our own operations. We like to consider ourselves an operations first company. So there's a large business. And so we invest in these everyday asset classes and then bring in our own vertically integrated operations to try and run them at an institutional quality level, providing a great product for our residents or our tenants, as well as then an institutional quality product for our investors.
Gabe, I'm just wondering if you can just tell me, what are you managing today in terms of assets?
Yeah, absolutely. So Avenue Living as a whole manages just over $6.5 billion in total assets. Our multifamily product, the core trust product that we're going to focus on today, represents just over $4.5 billion of that. Self-storage is about 1.6, and farmland is the remaining.
Wow. So you guys are not just a mom and pop operation. It's great to see the progression. It's absolute pleasure to be able to partner with you guys. We actually first started partnering with you when you first really came to the retail market in 2018. And since 2018, we've seen a beautiful growth pattern in there. It's been a wonderful privilege to be partnered with you guys in that season.
Oh, I appreciate it. It's fun. And I joined the firm in 2018, so kind of came on right along the same time that Raintree did. And so it's been an exciting journey to be a part of, growing from, the more family run private owner operator to the true financial institution that we represent today.
Amazing. Gabe, wondering if we can get a little bit more granular, just kind of speaking about the REIT. Some people don't really know what a REIT is. I'm wondering if you can just kind of give us a really brief overview, a kind of a simple man's version or simple woman's version of what is a REIT, and kind of just help give us an overview of what is this core trust in its essence.
Yeah, absolutely. So at its most basic level, a REIT or any large real estate institution, the plan is you pool investor capital in order to purchase a building or any form of real estate, rent that for cash flow, and at the same time invest in the property and invest in the operations in order to improve the cash flow of that asset. And if we want to go to a bit of a longer answer than that, I think it's kind of nice to give a bit of the history of what we've seen of the evolution of REITs, because we saw REITs happen. Really it became more of an industry in kind of the late 70s, into the 80s and into the early 90s is when we really saw that structure really start to take place in Canada. What's interesting about that, though, is if you think about real estate as an industry, it's quite new. If REITs came about in the late 70s, early 80s, into the 90s, as a strong industry, as institutionalized players being in the space, it's actually quite new when you compare that to, say, retail or industrial that has seen the larger institutions be in that real estate asset class for a lot longer. And so because of that, we've seen a fairly strong evolution between kind of the first players that entered into the space into the REITs that we see today, which truly are, really strong corporate citizens in terms of the investment into the buildings that they do, as well as providing a stronger operations, which is really tough to do in today's operating environment. Real estate was dominated by mom and pop investors, and it used to work. But in today's capital environment, in today's labor constrained environment, in today's debt environment, it is very difficult to manage an older style property or any really real estate property without the backing of a true institutionalized management structure.
Thanks, Gabe. And I think we're going to speak to some of those strengths in a minute. But I just wondering if we can take a step back and look at the economy. What do you see from a Canadian standpoint, specifically on the real estate side? What do you see as an investor, some of the headwinds? And when you describe that, maybe describe for us a little bit of maybe some opportunities that you see if you were an investor looking at real estate today.
Yeah, no, right now is a very interesting time for Canadian multifamily in general, and I would say this really across the country, but primarily focusing, especially in the prairies, where the affordability metrics still make a lot of sense for the resident. But in general, there is a bit large moat between players that are already in the space and already have a strong institutional management, and players that may be looking to enter into the space. If you are already here and you've got your operations and you've got relationships with the tier one banks and you've got access to materials and you've got access to labor, right now is probably one of the better times to be in the multifamily space. There are a lot of tailwinds. And primarily that's just driven based off of basic Econ 101, supply and demand. In Canada, we are seeing a very strong population growth trend, which is the demand side of the curve for real estate, as well as it's happening at the same time as there's been an artificial supply constraint just due to a lot of red tape, a lot of rising construction times, which have essentially tripled in the last 2 decades, as well as rising costs of construction. So you've got a supply constraint at the same time that you've got a demand influx that's causing a lot of pressure on the rental market, which ultimately is positive in the terms of an investor in the multifamily space. That being said, at the same time, for all those exact same reasons, it can be very difficult to enter into the space or to being a smaller syndicator or individual player in the space right now, because you are getting pressure on your cost construct. And so there are rising costs across the board. And again, that's labor, that's materials, that's taxes and fees, that's everything every cost is rising. So if you aren't able to have the institutional ability or know-how in order to try and combat that, while at the same time a broad enough real estate spectrum to be able to, raise the cost in terms of raise your rents or your revenue metrics, but doing so spread over a number of units, so you're not putting too much pressure on your residents and doing so in a socially responsible way, then it's going to be a really tough scenario and you might be caught out to dust. And we see that quite often in terms of who our vendors are that we acquire from.
There's been some really interesting acquisitions that you guys have made over the last couple of years that I think is really, really powerful to look at how you guys have syndicated or, added things into your portfolio, where I think you've added a significant value for, everyone. I always, oftentimes people get nervous when they jump involved or invest in a multifamily REIT, thinking that, oh man, am I benefiting to somebody else's detriment? Are they being like kind of a slum landlord or something like that? One of the things I've really come to appreciate is that you guys look at really kind of what I'd call a three-way win. What does it mean for Avenue Living to win as a company? What does it look like to create wins for the end users, to be great managers of great properties, so that client and the end user, meaning the client, is really happy. And from an investor standpoint, how do we create, reasonable returns for people who are entrusting you with their money? And so I'm wondering, in that environment that you just finished describing, I'm wondering if you can speak to that, speak to kind of how is it that Avenue Living has been able to strike that balance? And I'm wondering if you can maybe speak to even a few examples.
Yeah, absolutely. So just to start on that, it's kind of back to my point that we discussed earlier about the nation practice of the environment. It's quite new in terms of the institutional players. And when you look at any industry, when something is first becoming institutionalized or financialized, to use the term that often is used in public discourse, is you see a number of bad actors that enter into the space. And it's whatever you want to call it. The dawn of the internet saw a number of individuals that were, bad actors into the space. Whether you want to talk about the free banking era, a couple hundred years ago, or even in today, just a fun example of the cryptocurrency industry is it's new, it's interesting, it's exciting, there's capital into it. And so it invites players that are going to do untoward things. I like to think that we are in a financialized 2.0 era where the REITs that exist today that have made it through and crossed that chasm are no longer able to do the things of the past. So there's a good reason why, REITs can have this kind of reputation historically. And because there were a lot of players that were doing things that were not being good corporate citizens. That's the reality of the industry 20, 30 years ago. At this point, all of the REITs that exist are strong corporate citizens. And obviously there's individual companies that are doing things, but the vast majority of players in today's space, and both through regulatory regime, transparency, as well as just consumer demand and the market-based economy that we live in, it demands that you are a strong corporate citizen. Because if you are not investing in your properties, but you're trying to raise rents, well, an individual is going to go somewhere else, or you're going to get hurt by the media, or you're going to find that your brand reputation is tarnished. So we make sure that we invest in our assets in order to improve the service standard. It's no different than any other business in the sense of customers are willing to pay a larger share of their wallet if they feel that they're getting equal or hopefully above benefits and services for that capital that they are providing. So the way that we like to think about it is we're going in, when we look at an asset, when we're underwriting it, we try and see where's our opportunity. And sometimes that has to do with the rent level. And sometimes it doesn't have to do with that there's a gap to market where the rents are too low. We've bought assets where the rents have been too high, and the operator has been operating at too high a vacancy. And we felt that we could run at a lower cost construct and actually reduce rents closer to market. We've also then bought assets on the other side of the scale. And we also buy things that we believe that have, larger deferred maintenance in terms of investment capex, that the property itself or the product is not up to today's standard. So that's things like your old carpet, that's your linoleum tile, that's your pink bathtubs. The reality of Canada is about 80% of multifamily was built pre-2000.
Hold on. You're
Yeah.
telling me that if you bought a property with a pink or lime green bathtub, you would change it?
Turns out people don't want that anymore.
Oh
I'm sure there's
man,
a few, but they're harder to find.
it's retro. It's retro.
And maybe it's coming back.
Oh man, I want to. I think you alluded to it, but I think you're being too modest. And I'm wondering if you can speak to something that I think you've really become an industry leader in, is this kind of fancy word is ESG. You guys have done an awesome job of partnering with federal and provincial partners to really make phenomenal investments into your properties that are incredibly environmentally and economically appropriate. I'm wondering if you can maybe just comment on some of your ESG type strategies.
Yeah, absolutely. No, there's a very There's a very strong case to be made within real estate for the types of assets that we buy, which are older style, in order to invest the new technology that exists today to make them environmentally friendly. Because what that does is it actually not only does it provide, a betterment for society as a whole, but it also provides a better rental experience for the renter, as well as it actually saves us money because the building can run more efficiently. And so if you think about a development that was done in the 80s or 90s or even early 2000s, sustainability just wasn't in the lexicon. Nobody was thinking about that. And we didn't have the same kind of technology that exists. So we do the basic things that you'll see a lot of operators talk about. Triple panel windows, putting in high efficiency boilers, LED light bulbs, those style of things. To us, that's kind of table stakes. Where can we take that to the next level? And the next level is really unique things. And this comes from exactly what you're talking about, public-private partnerships, as well as a number of other programs. We've got a large infrastructure bank program that's actually now we're doing a lot of work through BMO that actually has their own infrastructure program. And so what we are looking at doing there is where can we put solar panels on this? And one of the major, really cool ones is in Edmonton. We've got a redevelopment of a very older style concrete tower that faces a lot of sunlight on one of the sides of the building. And we're putting a vertical solar mural down the side of that. So the mural represents a number of the unique aspects of the neighborhood. The solar panels are going to help power the building, and it actually is. We don't have an official piece on this, but we believe that it's going to be the largest vertical solar mural in the world. And so those are the kind of unique things of where do we take this to the next step forward to really provide a cool experience for the renter as well as our investors to be able to invest in this.
Well, and I think this is really what sets you guys apart is I think a lot of times people talk about efficiencies and that green footprint, so to speak, lip service. I don't think you can be a good corporate citizen without kind of at least a little bit talking about it. But I think you guys are again trying to take it to the next level and not just doing your part, but you're really trying to be a leader in the space. And so thank you for that.
Oh, I know, I appreciate it. Yeah, it's taking the ESG back to its basics. When it was first created as a term, it was how do you actually help things for the environment to make it more sustainable as an investment? How do you do social impact? Because if you don't do that, eventually your brand is going to be tarnished. If you don't practice good corporate governance, your brand is going to be tarnished. So taking it away from the buzzword and into just the basics of what was the intention of that.
Beautiful, beautiful. Thanks, Gabe. I'm wondering if you can kind of speak to the metrics of if obviously past returns is no guarantee of future returns. But and again, this is not a statement of suitability. Like if you're watching this, it's not like, oh man, these are quote unquote guaranteed returns. But I think you guys have been really good at buying the boring everyday assets. That these are really been fairly stable since you guys have been in the market. And I just wondering if you can speak to what an investor might anticipate from an investment return standpoint, both from a cash and cash yield standpoint and also from an overall growth standpoint.
Yeah, absolutely. So we invest in what is called in the industry, we call it core or core plus real estate assets. So these are ones that are, their existing cash flow, but not optimized cash flow. And that's where we come in with our operations, with our CapEx, et cetera. And so with that, we look to generate a return to our investor through monthly cash distributions, or if they want to reinvest, there's an option for that as well as then capital appreciation. So the capital appreciation comes from us going in and improving the building. If we improve the cash flow that is coming off of the property, then the value of that property is improved, which leads to valuation gains for our investors. And so what our targeted returns are is we pay a monthly distribution, our targeted monthly distribution, which is approximately a 5% yield, as well as then the additional amount, we target a total net return to our investor of about 8 to 12% on an annual basis. So anything that's not made from the distribution is made up through capital appreciation. So far in the last 4 years, we've been quite successful at being closer to that upper end of that targeted range, which is something that we're very proud of. And just going back to the kind of macro forces, tailwinds, headwinds, something that we're very confident that we're going to continue to see within those targeted returns.
And even from a tax efficiency standpoint, one of the things I do appreciate is for those that, you could buy this in a registered account like a TFSA or RSP, but you can also buy this directly. And so if someone owns this directly, they're able to see that as a return of capital. Fair. Like, again, it's, not every year is a guarantee, but certainly there seems to be some tailwind there where when a client is receiving that 5% distribution, that they're receiving it as a return of capital, which is one of the most efficient ways to receive a revenue source. Fair?
That's exactly right. So to date, we've had all of our distributions have been 100% return of capital, so a very tax efficient format. And then going forward, my accountants here would kill me if I ever gave a target, as it's an annual calculation. But we do our own internal modeling, and if we continue to progress along our business plan the way that we've drawn it out, we definitely see that continuing for the foreseeable future.
Amazing. Thanks, Gabe. The thing I love about the way you guys can be positioned in somebody's portfolio is kind of the table stakes of a beautiful, blend of, when we go back to the 2022 market where the public market was way down, offhand, you recall what you generated in 2022?
It would have been approximately around the 11 to 12% mark.
Absolutely. And, again, Gabe, I appreciate the fact that, you're not having to do catch up. You're not trying to do all of these recovery maneuvers. And so, again, this is not a statement of any kind of GIC guarantees, but you guys have proven yourselves to be a beautiful asset manager, really trying to invest in the everyday, really trying to invest in, kind of the table stakes of people's needs. And so thank you very much for that.
Oh, I appreciate it, Ian, and appreciate your support.
Last question to you. If someone was just trying to figure out, why would I trust my money with Avenue? Why would I continue to trust my money with Avenue? Why Avenue? Why should we trust you?
Yeah, that's a very good question. I would answer that in you are investing alongside a number of different potential benefits, and one of them would be time and experience. Avenue Living as an organization has been around since 2006. We're coming up on 20 years of operations in the multifamily space. Our co-founder and CEO is still involved in the business every single day. He's seen the global financial crisis. He's seen the commodity crisis. He's seen COVID. He's seen the interest rate hiking cycle. We've been through it. So a ton of experience. You're investing in diversification. We've got over 500 properties within the core trust product, over 18,000 units. Things happen in real estate. Fires, disaster, things happen. One building going down isn't going to affect us because that's part of the business. So it's spread across an astronomical number of buildings. You're also investing alongside a management team that is very strong alignment. The founders' capital is still invested in the business today. We're talking through founders and management, almost $300 million that sits pari passu or equivalent with all of our investors. You're also investing alongside a significant amount of other investments. So we have over $3 billion across the Avenue Living platform in total equity invested. So you are investing alongside a significant amount of other individuals that are also trusting the capital within our portfolio, as well as then a strong business plan. And this one is a little less historical, more looking forward. But to your point and to what we've discussed is we invest in the everyday. We house the workforce of Canada. We are your basic core product. It might be the least sexy business on the planet, but it is one of the best to be able to continue to hit targeted, reasonable returns for our investors, providing a good, strong customer service for our residents.
Gabe, on behalf of all of my clients who are invested with you, on behalf of my own capital that's invested with you, thank you. Thank you for your leadership and your continued stewardship. Thanks for joining us today on Money Match.
Appreciate it. This was fun. Thanks for having me in.
Check us out on the website, ardillgroup.com. And you can always check us out for more videos on YouTube. And until next time on Money Match, our door is always open. Cheers.